Is the mic? Okay, thank you very much. Hello everybody, my name is Christian Gollier. I'm chairing this first part of the afternoon after a very nice lunch and a sunny park. I hope now people are coming back for this first session of the afternoon. We have a presentation by Lucian Taylor. I propose 25 minutes presentation and to allow for 5-minute discussion. So be prepared for question. If you are in distance, you can raise question on the Q&A. And in presence, you just raise your hand at the end of the presentation. So let me spend just half a minute for presenting Lucian Taylor. Lucian Taylor is professor of finance at the Wharton School of the University of Pennsylvania. He's a well-known specialist of empirical corporate finance, asset management, and sustainable investing. Of course, a very topical issue for this conference. So, Lucian, are you here? Could you switch to the... Okay, here.
Hear you loud and clear. Hello, hello.
Okay, Lucian?
Yes, I hear you.
Okay, so the floor is yours. You have 25 minutes.
Okay, well, thank you. Bon après-midi. Well, hello, everyone from Philadelphia. Thank you for this invitation. Thank you all for coming. I'm so sorry I cannot be with you in Paris. So today I'll be talking about some research I've done with Rob Stanball and Lubos Pastor. The motivation is this dramatic increase we've seen in sustainable investing. Here I'm showing the dollar flows into US sustainable mutual funds and ETFs. This explosive growth in ESG investing, it's one of the most dramatic stories we've seen in finance over the last decade. In this paper, we ask, should we expect superior returns from sustainable investments? If you ask investors that question, they often say yes. So here I'm citing 3 surveys in which they ask people, why do you do ESG investing? And the answer that comes in first place or second place is they do it to get higher returns. The BNP Paribas survey asks, do you expect your ESG portfolio to outperform? 60% answer yes. A little less surprisingly, asset managers, they often say yes as well. For example, here's Larry Fink of BlackRock saying, integrating sustainability can help investors build more resilient portfolios and achieve better long-term risk-adjusted returns. And indeed, when you look at the data, if you look at the historical performance of certain ESG strategies, the performance looks good. So a lot of people are saying yes. In this paper, we say the opposite. We say no. We say you should not expect superior returns from sustainable investments. There are 2 reasons we say no. The first is appealing to economic logic. We have a theory paper before this paper, and our theory predicts sustainable investments have lower expected returns for 2 reasons. First reason is there are these ESG investors out there who like sustainable investments. That means the demand for those is high, so sustainable investments today have high prices. Equivalently, they have low expected future returns. The second reason is about risk. We argue sustainable investments are safer because they offer a hedge against climate change risk. And since they're safer, investors will accept a lower expected return on them. The second reason we say no is really about today's paper. This is supporting empirical evidence. Today, I'll hopefully convince you that the past superior performance on a green investing strategy was unexpected. We'll argue that concerns about climate change increased more than anticipated over the last decade. That had 2 effects. It led investor demand for sustainable financial assets to go up. In other words, there was price pressure on green assets relative to, I'll call them brown assets, and that led to high realized returns on green assets. The second effect it had was on customers. Customer demand for sustainable goods and services also increased, which again led to high realized returns on green assets relative to brown. And some of this customer demand could have been pushed by government regulation. So overall, the message of our paper is that this really strong past performance we've seen on green strategies should not lead us to expect high future performance on green. More broadly, the average return on an asset, for example, a green asset, is often a bad proxy for the expected return on that asset. Before I summarize our main results, let me provide a really simple, motivating example. And this is about German twin bonds. So this is about sovereign bonds. The government of Germany has been issuing green bonds since 2020. These are bonds they're issuing to finance their transition to a green economy. The first issuance was in September of 2020. It was a 10-year bond, zero coupon, 6.5 billion euros. What's very useful to us as researchers is that each green bond has a conventional twin bond. They share the same issuer. These are both German sovereign bonds. They share the same maturity date, the same coupon rate, and the same coupon payment dates. So these twin bonds offer identical cash flows. They differ only in their greenness. And that's useful because it lets us ask, what's the effect of greenness by itself on expected returns and realized returns? So let me show you the data. Here I'm looking at one pair of these bonds, and I'm plotting their yields to maturity. The green bond is, well, it's in green here. All the yields are you'll see, are negative. So we all know this was a period in Europe where yields were negative. What's more important to us is that the green line is always below the blue line. So the green bond always had a lower yield to maturity. These yields are interesting because they are a measure of expected returns, at least for a buy and hold investor. So what we're seeing is that the green asset always offered a lower expected return. That supports our paper's message that green assets have lower expected returns. You can see that even more clearly if we compute the gap between the green and blue line, and I'll plot that gap up above. That gap or that yield spread is often called the greenium, and it was always negative. So for example, if we take this date when the bonds were issued, there was a slight greenium, 1.5 basis point per year, very modest. But that greenium should lead us to expect that the green bond would underperform its twin. Did the green bond underperform? No, the opposite happened. And we see that down below where I'm plotting the cumulative realized return that you would get by buying the green bond and shorting the twin bond. And what we see here is that the green bond outperformed. So even though the green bond had a lower expected return, it had a higher realized return. Okay, well, should we look at these really strong green returns, and should those lead us to expect high green returns going forward? Well, the answer is clearly no. Look at the greenium again. By the end of the period, the greenium was actually lower than where it started. So if anything, you should especially expect the green bond to underperform going forward. And in fact, the outperformance of the green bond came entirely at the expense of its expected future return. We're seeing that the reason green bond outperformed is that there was a shift in its discount rate, a shift in its yield. Another thing that's interesting here is what happened in July and August of 2021. You may remember that Germany was suffering just devastating floods during that time. It was the worst natural disaster to hit Germany in decades. Dozens of people died. And if you look at polls in Germany at that time, concerns about climate change increased in the polls and became one of the most politically kind of concerning topics to people in Germany at that time. And we think it's no coincidence that those increasing concerns about climate change coincided with some of the steepest deepening of the greenium in Germany. So we think it's a useful example of how a green asset has a lower expected return, but can outperform during a short period of time. So we like this case study because it's simple. Most of our results, though, are about stocks. They're about US stocks. So first, I'll show you that green stocks outperformed brown stocks in the 2010s. A green stock is going to be an environmentally friendly stock. Brown is environmentally unfriendly. So in this paper, we're focusing on the E part of ESG, the environmental part. For example, I'll show you a green minus brown stock portfolio, Valuated. Its average return was very large, more than 0.5% per year, highly statistically significant. I'll also show it a different way by showing you a green factor. It's also long green stocks, short brown stocks, but now we're going to weight stocks by their greenness. And that green factor also had very high returns, again, above 0.5% per month, highly statistically significant. So green assets outperformed. Our main result, though, is this one. I'll show you that the green factor's outperformance was unexpected. It was due to unanticipated increases in concern about climate change. The way I'll show that is what you'll see is the outperformance of green assets vanishes if we counterfactually set those climate concern shocks to zero. In other words, what I'm going to show you is that the factor's realized return exceeded its expected return during the 2010s, during this short period in time. I won't have time today to show you, but let me advertise another result. We'll show, in the paper we showed the green factor's outperformance helps to explain the historic underperformance of value stocks relative to growth stocks in the 2010s. So usually, value stocks outperform growth, but the 2010s were different. The 2010s were the worst decade on record for that value minus growth strategy. We help explain why. The explanation basically is that value stocks tend to be brown. Think about coal stocks, for example. Growth stocks tend to be green. Think about, I don't know, Tesla, for example. Also, we'll show that this green stock factor, it reacts to climate concern shocks with a delay of a few weeks. So it's looking like small stocks are underreacting to climate news. So let me say a little about how we measure stocks greenness. We use data from MSCI, their ESG ratings data. This is seems to be becoming the gold standard of ESG ratings in industry as well as the academic literature. I won't have time to go through the details. Let me just mention that we use two variables from the MSCI data. The first variable is called environmental pillar score. That's how well the stock scores on a broad range of environmental issues. The second variable we use is the environmental pillar weight. That's capturing how important is environment relative to social and governance issues in the stocks industry. So let me just show you a quick sanity check. Let's look at one snapshot in time, and let's rank industries from the most green up here to the most brown down here. Let's start down here. What are the dirtiest industries? It's kind of what you would expect. Chemicals, oil and gas, steel, metals and mining, non-precious. That would include coal mining, paper and forest products, marine transport. So it's comforting that industries we know pollute a lot show up at the bottom of the ranking. It's a little more surprising which industries show up as being the most green. It's asset management, professional services, telecom, consumer finances. So these are industries that don't have big environmental impacts. All right, next, let me show you some returns on valuated stock portfolios, a green portfolio and a brown outperformed the brown portfolio. It outperformed by about 170 percentage points from 2013 through the end of 2020. And that outperformance was accrued pretty steadily over time. You can also compute green minus brown, a GMB or green minus brown return. That's showed with this dashed red line. That would have also given you very high returns. You can also show the outperformance by looking at this green factor I mentioned. It's a theoretically motivated asset pricing factor. Again, it's going long all the green stocks, going short all the brown stocks, but now we're going to weight them by how green they are, not by how large they are. And it performed quite similarly. So we're going to focus on this green factor going forward. And we want next to try to explain why the green factor performed so well over the last 10 years. What I've just shown you is that the green factor's realized return was positive over that period, but its expected return is negative, at least according to our theory paper. So how can we reconcile the data with the theory? Well, our theory actually helps us. It gives us a way to reconcile them. Our theory also predicts that this green factor's return, its realized return, can be positive during short periods of time when tastes are shifting unexpectedly in a green direction. You can think of a customer channel and an investor channel. The customer channel says maybe consumer demand unexpectedly shift away from dirty products toward clean products, maybe with the help of government regulation. The investor channel says, well, maybe investor demand for green assets increased unexpectedly, and that led to these high green stock returns. So that investor channel would be about the rise of ESG investing, for example. So there are lots of reasons why you might expect these shifts in demand. We think one plausible source of shifts is climate change. One thing that was very special about the 2010s is that there was a great awakening to the climate crisis worldwide. So next, we're going to ask, can the green factor's positive past performance be explained by increases in concerns about climate change? So we have to measure those concerns, and we're going to measure them using this Media Climate Change Concern Index constructed by a different set of authors. Their index, it aggregates data from 8 major US newspapers. So it captures the number of climate change news stories every single day. It also captures those stories' negativity and focus on risk, at least as measured by their textual analysis. So we're going to measure the level of climate concerns at the end of each month, T. So basically, we're going to say how concerned you are about climate at the end of this month, T. It depends on how much scary climate news came out that month. But we also allow investors to remember news from the previous months. And this parameter rho is capturing how long climate news is persisting in people's memories. So here's what you get. The red line shows you the level of climate concern over time. This dashed line shows you the beginning of our sample. What we see during our sample period is this huge increase in concern about climate change. I've also plotted here in the blue line the cumulative green factor return. And coinciding with that increase in climate concern, we saw this big run up in stock prices of green assets relative to brown assets. And it's not just about the run up. It even looks like some of the ups and downs are lining up with each other. You might be wondering, well, what happened before that date? Well, before that date, we actually saw a decrease in concern about climate change. And this dashed line shows you what that green factor would have looked like beforehand. It basically would have been flat, maybe even downward sloping in that pre-period. So next, we want to study this pattern a little more carefully by running a regression. We're going to run a regression. On the left-hand side, we have the monthly return on the green factor. On the right-hand side, we have the month-over-month change in climate concerns in both the contemporaneous month and the previous month. And what we find is a significant coefficient on the lagged climate concern increase. So what we're finding is that bad news about climate change last month is good news for green stock returns this month. And we're finding a pretty big R squared, a 17% R squared. So climate concerns, how are they moving prices? Is it through a cash flow effect? Is it through a discount rate effect? We look into that in the paper by including two measures of cash flow news, earnings announcement returns, changes in analysts' forecasts of earnings. We also include a measure of investor demand shifts for green assets by measuring the flows into ESG funds. These three extra variables, they come in with the expected positive coefficient, but they don't enter significantly. At this point, we can't tell whether these climate concerns are moving stock prices because of a cash flow effect or a discount rate effect. What we want to do next is the main analysis in the paper. We want to run a counterfactual analysis, a what-if analysis. We'll ask, what if the last 10 years had been different? What if there had been no changes in concern about climate change? What if there had been none of these, what if there had been no cash flow news about green versus brown stocks? To answer that what if question, we're going to use this regression in column 2. We're going to set the change in climate concerns to 0 every single month during our sample period. And we're going to by doing that, we're going to recompute the return. What would the return have been if that regressor had been equal to 0? Those counterfactual green factor returns are plotted here in red. As a reminder, the blue line shows the actual realized returns on the green factor. So we know the green factor massively outperformed. What we find, though, is that outperformance vanishes if we counterfactually set those climate concern shocks to 0. In other words, what we're finding here is the only reason green stocks outperformed brown is that there were these big increases in concern about climate change over the last 10 years. As a further step, we're going to look at what are the components of the green factor returns. We can turn off those shocks one by one. First thing we'll do is we're going to turn off the climate change concern shocks. When you do that, instead of seeing this realized return, you would have seen the green dashed line. So it looks like the climate news is doing most of the work in shutting down or making those green factor returns vanish. Then, as a second step, we additionally turn off the cash flow news. Then you would have gotten the red counterfactual returns, not much change. As a last step, we turn off ESG flows. We ask, what if there had been no inflows to ESG funds? Well, then you would have gotten this downward sloping orange line. So this picture helps reconcile theory with data. Remember, our theory predicts a negative expected return on the green factor. That's consistent with a downward sloping orange line. But our theory also says that if there are enough shocks, that can lead the green factor to outperform. And that's exactly what we saw in the data. So to conclude, what we're finding is that realized returns exceeded expected returns for green assets in the 2010s. Again, this was due to unanticipated increases in concern about climate change. 3 important implications. Number 1, bad news for ESG investors. You should not expect green outperformance to continue. Number 2 is about cost of capital. It's important to remember cost of capital and expected return are the same thing. So we're finding that green firms' cost of capital is lower than their recent returns would expect. And a broader message is that it can be very dangerous to measure expected returns using recent average realized returns. I'll stop there and answer questions. Christiana, I'm having trouble hearing you. I think Christian's mic is off.
Let me try. Oh, yes, the green one. Not a surprise. So thank you very much, Lucian. So we have time for a few questions. Let me start by one. So you stole my question from your conclusion. It's very important to remind the audience that the return on the assets is the cost of capital of the firms, and if we want to promise a larger return, it's also meaning we are increasing the cost of capital of those firms, whereas the objective of green finance is to reduce the cost of capital of green corporations. So it's good to remind the industry that the important things. Are you talking about green bubble, Lucian? In fact, when you say the excess return came from the fact that more people came in realizing that climate change is important. So one question, and the related question is, what will happen when the price of carbon one day will arrive in the US? I cross my fingers. There will be a pursuit of the excess return of those green assets compared to brown assets. What do you want to say about that?
Yeah, starting with the bubble question, I do not think there is a green bubble necessarily. The word bubble suggests that there is mispricing. I don't think there's necessarily mispricing. These high returns you've seen on green assets could be perfectly rational for 2 reasons. It could reflect higher expected cash flows for green firms, or it could just reflect that investors' tastes for green assets increase. That's completely rational. To your second question, what if we see, let's hope to God, carbon pricing in more countries, including the United States? Well, we would argue that that is a cash flow shock that helps green firms and hurts brown firms. And I would expect high green returns if that happens.
So, thanks a lot, Luc, for a very inspiring presentation. I wanted to ask you, so we learned from your talk that the outperformance of green stocks could have an end. And I wanted to ask you about what could be a trigger for a change in these green preferences. So how could they switch in the future? So what are your concerns about that? And then another question is about the European markets, because we have maybe more flows into European green funds in Europe. So I don't know if you started to do an analysis in Europe, but what would be your expectation? Because for me, it's a bit mixed, because on the one hand, you have more ESG flows, but on the other, if you think about stock returns, they are correlated between the European and US markets. So maybe we could think that there is less importance of ESG flows in explaining stock returns in Europe. So what would be your insights on that?
Yeah, those are excellent questions. First, why did investor tastes shift? Do we expect them to shift in the future? I wish I had a good answer. I don't. Anecdotally, one thing I hear is about a generational change. I hear it's especially younger generations who incorporate their values into their investing. If it's about demographic shifts, then maybe we'll see even more of it. The second question. I'm blanking on it. Can you please remind me?
Do you see also a risk of changing preferences in the other direction, right? We hear a lot about greenwashing right now. So do you think that preferences could also reduce for green assets? Do you see that as a risk?
Yeah, I mean, absolutely. I mean, one thing that's I'd be interested to see is like, what's the effect of the recent war in Ukraine? Has concern about the war crowded out other concerns, including concerns about climate? I don't know. But we do have an interesting episode from the pandemic. I was curious whether the pandemic would crowd out concerns about climate change, but it actually looks like the opposite happened. ESG flows seem to accelerate during the pandemic. So it looks like people's brains were big enough to be concerned about two things at the same time, the pandemic and climate change.
Thank you, Lucian. We need to move on with the agenda. So let us continue to bet on the better perception of the citizens of this planet, of the importance of reducing greenhouse gases. Thank you very much, Lucian. That was very enlightening. Thank you. So now I give the floor to Michel.
Oups. Bonjour, etc. And no, yes, sir. It is on the screen. Do we have Orit from Lausanne on the screen? Comment? Elle arrive? Okay. Well. Good afternoon, everyone. I'm Michel Crouet from Natixis, and among other things, I'm chairing the scientific committee of the Natixis Foundation for Research and Innovation. The Natixis Foundation has been a loyal sponsor of the Risk Forum since its first edition in 2008, 14 years ago already. So each year we organize a roundtable on a topic related to the central theme of the conference, and this year the theme of the Natixis Roundtable is steering the greening of the balance sheet of financial institutions. Just a few words just to give you some context. The core objective of the Paris Agreement on climate change is limiting greenhouse gas concentration to a level which is consistent with a warming level below 2 degrees Celsius above the pre-industrial levels, with a global objective of zero net emission after 2050. So the question, the million-dollar question is, how do you get there? How do you achieve this goal? You can think of coercive measures like carbon pricing to force companies to reduce their emissions. And there is also a system, you can think also of systems of incentives that can amplify the effectiveness of public policy. There, financial institutions have a critical role to play through the preferential funding of green projects or and on portfolio selection of stocks of green companies and companies transitioning to green. So the roundtable will discuss the current methodologies adopted to green the balance sheets of financial institutions, and indirectly to incentivize companies to reduce their emissions. So now let me introduce the participants to this roundtable. We have Louis Douadi. Louis is a global head of ESR at Natixis Global Financial Services. Basically Natixis Corporate Investment Bank, CIB. And Louis is going to be the moderator of this roundtable. Louis has all in store, all the good questions to ask to the panelists. We have Orit Azulay. Orit is a global head of Green and Sustainable Hub at Natixis CIB. We have also Eric Decker. Eric is head of Global Investment Office at AXA. And next, but last but not least, Nicolas de Genlis. Nicolas is Sustainability Associate at Deloitte. So AXA and Natixis will present their strategies to reduce portfolios' impact on climate and climate change and to meet emission reduction targets. And Nicolas from Deloitte will present a benchmark with other financial institutions. So I'll turn it over to Louis.
Thanks, Michel, for these words. Yeah, since the launch of the principle for responsible investment and its pendant for the banking industry, the PRBs, we've seen a number of financial institutions publicize their strategy towards steering their books towards transition. And that has even amplified with the setting up of net zero alliances this year in the wake of the Glasgow COP conference. So my first question would be to you, Nicolas. Can you elaborate for us and explain to us what are the various methodologies used by financial institutions to set the base for these steering strategies?
Sure. Thank you, Louis, for the question. So the very first point about that is that you will probably discover during the panel there is no one-size-fits-all method to steer a portfolio. So that's the first thing. Second one, I will explain different methods are needed at different stages of the investment cycle or credit life cycle. The very first approach that you will hear about when we talk about steering a portfolio is called sector decarbonization approach. So I will explain how it works. The principles are pretty simple. So as you know, it has been mentioned by Michel, in order to limit global warming to 2 degrees Celsius, we have a carbon budget, a worldwide carbon budget. So that is designed and modeled by science. That carbon budget can be then downscaled to region and to sectors. So that is done by economists. This is what we call climate scenario. You're aware of that. So basically, we do have a specific carbon budget for sectors and region. And so the purpose of what we call the sector decarbonization approach is basically to benchmark some assets in your portfolio to a climate scenario. So let me give you a very specific example. You finance real estate. That real estate has an energy and carbon performance, which is measured, for instance, in CO2 intensity, CO2 per surface, square meter, and then you compare that to what should be the performance of real estate in 2030 and 2050 according to climate scenario. So that is what is called a sector decarbonization approach. This is one core method which is pretty well known and used for strategy and reporting purposes. But that approach is usually considered as non-sufficient because it could be considered as too simplistic, because it means that whenever you take an investment decision or a loan origination decision, you just have one single metric, which is basically the carbon intensity of the company. So as a consequence, what financial institutions are doing is that they're using ratings. So that's the second family, I would say, of methods. Those ratings do take into account the carbon intensity of the company, but not only that. They add as well, for instance, management willingness, R&D capabilities, etc. So that's really the second family of method. And to your point, the very last family of methods, which is something that you discussed a lot today, are risk modeling methods. Because you could have a very nice portfolio measurement sector decarbonization approach, great ratings. As long as this is not articulated with risk models, then you won't steer the portfolio. The three components are absolutely critical. And so that we will probably discuss later, but among the many approaches that do exist to integrate climate into risk management, regarding transition risk, one of the most commonly used is, of course, an internal carbon price.
Thank you, Nicolas. Now maybe to get a more practical view of how financial institutions are driving this strategy, I'll turn to you, Eric, and in order to understand what a large insurance group with a strong asset management activity is doing to implement that strategy.
Hello, everyone. So Eric Decker, AXA. I work just on the context. I work on the AXA side, not the AXA IM side. So AXA as an asset owner. Balance sheet size, more or less, is around 550 billion. And I think it's important to put those contexts, for everyone to understand. So, thank you for the few words of introduction, because it leads into what we are trying to do. So obviously, this decarbonization path of mainly banks and insurance companies, we're just at the beginning. But there's still a few things I want to say, because as AXA, we've made several commitments, net zero to 50, like so many people have done. So we have also a green investment plan, i.e. investing up to 26 billion in green investment by 2023, which we're going to do. But this is not the target that worries me, coming back to the introduction and basically the topic of the day. It's decarbonizing the portfolio. So what does that mean? So we're part of the Net Zero Asset Owner Alliance. There are 71 other members. So mainly insurance companies, pension funds from around the world. We have set a first intermediate target, decreasing the carbon intensity by 20% between 2019 and 2025. Does not cover the 550 billion of assets, because we don't have data on 550 billion of assets. That we may discuss access to data, a bit later on in the speech. So first, we have 20 minus, therefore, as I said, 20% on about 200 billion of assets, which basically are all the liquid type of assets that we have on the portfolio, excluding govies. Govies is entirely another topic. It is not necessarily only portfolio construction. It's also ALM, solvency, local entities, because AXA is all over the world. We just cannot say we're not going to invest in one particular govie anymore, even for climate topics. Has political ramifications, solvency, relationship with the regulators. And anyways, what's important is that the target is set within work that is being done within the Asset Owner Alliance. And govies has not yet been covered by the protocol, the Net Zero Asset Owner Alliance protocol, which I invite you to read, obviously. So those are kind of the high level topics. We can, later dig into the approaches, the SDA approach or SBT or any kind of other approach that we are doing. But it's, what I want to say is that it's concretely, we are going to reduce the carbon intensity of our portfolio. That leads into many management topics, i.e. asset classes in which we're going to invest more or less, different names within each asset class or different sector. You cannot be net zero to 50 or meet whatever intermediate target, if you want to meet them, by just keeping investing in the same names that you have done in the past, unless the real economy moves really fast, faster than the management of your targets. So those are the many of the challenges that we have.
Just a quick question to Eric. When we prepared this roundtable, I asked you if you divest from your portfolio. You said no. So how can you achieve, this target of 20% reduction in carbon emission without divesting?
No, the first target is minus 20% between 19 and 25. That's an easy one. It's a first step in the right direction, but you can do things at the margin. So we have divested from a few names which are on the exclusion list, mostly things related to coal, because many of us have an exit strategy on coal. So that helps the carbon footprint of your investments. And then we also have new investment that we do on a regular basis. AXA, we invest roughly 40 billion a year. So that's enough, to start moving the needle. Another reason why we don't sell is because of the pure size of the balance sheet. We just cannot go on the market. We have accounting impact, solvency impact, ALM issues. So we just, at least as of now, don't have to divest in order to meet the minus 20% 2025. The next intermediate target, which will be a target of 2030, more or less in the range of 50%. I have no idea. We haven't fixed it, but it's somewhere going to be in there. That's going to be challenging. I have no idea how we're going to meet that as of now, unless the real economy really moves.
Thank you, Eric. Now, wishing to gain a perspective on the banking side of the market, I'll turn to you, Orit, and to understand how Natixis CIB, so the commercial investment banking arm of Natixis, has done to define its strategy towards greening its balance sheet.
Yes, thank you. I hope you hear me properly. The strategy we've put in place first has been phased with the deployment probably in what Nicolas mentioned of a rating, which is embedding the sector approach, which we call the green weighting factor, with the first with the aim of having a very practical operational monitoring tool for our portfolio, qualifying the climate and environmental performance of each and every one of our financing, and again with a rating which is expressed in a color from dark brown to dark green. And then from for the first 2 years of the use of the scheme, what we have done is I would say emphasize the carrot element, if you allow me the expression, by creating a systematic evaluation of each and every one of our financing in a mandatory fashion as part of the credit process ahead of credit decision, for at least one reason, making sure that ahead of credit decision, as part of the decision-making tools, that evaluation was made available. And we even went one way further, which was creating an alternative view of our of the performance of the financing, with the expression of an adjusted risk-weighted asset and adjusted ROE based on that evaluation. The reason behind it was to start and create a altered perception of performance. That is the first phase in which we got involved, and then what we have put in motion was the second phase, where the stick got introduced in the game, if I may say, which is defining targets, and those targets have been defined in color as to color mix, as well as with an expression in temperature of our portfolio, which is with the definition of a 2024, 2030 target and a 2050 longer term target. So that's in terms of the tools we've put in motion. Now I'll be happy to get in a bit more detail afterwards. But to come back to what Eric was mentioning, what's very clear for us is that to steer our transition, we're going to have multiple levers. And our sector exposure is one. Our client portfolio is another, meaning who do we back? What we do with our clients, so what products, and lastly, how we manage our portfolio. And I think what we're trying to put in motion is a dynamic monitoring of our climate exposure, climate performance, both in terms of risks and opportunity.
Thanks, Orit, for this perspective, and we'll come back in a moment on the implementations detail. But maybe we'll start with you, Eric, when it comes to the practical process or sequence you've followed to implement the strategy within AXA. What were the main constraints? What are the hurdles you had to cross in order to implement this strategy?
The first step before even starting to speak about a strategy was to internally, I know it's kind of administrative, but it was just to set up a report. I mean, a strategy is a strategy, but then you need to have numbers. You need to be able to back what you're saying. So we had to pick and choose which of the asset classes we want to cover. So we rely quite extensively on the Net Zero Asset Owner Alliance, protocol. So we have 3 asset classes, as I mentioned, that we take into account. So listed equities, liquid bonds, and real estate. So we needed to get data to calculate the carbon intensity. So that means emissions, and then the denominator of the carbon intensity. There's been a lot of debate. Is it EV or is it turnover? We chose to go along with the EV, and so rather even than absolute, we calculate the evolution of the absolute because that's just a numerator. But basically the idea, the target was, and still is, decreasing the carbon intensity. Why? It's also because if you talk about a budget, carbon budget, to some extent which it is, because we have a bit of moving amount of volumes of AUM, because we are adding new coverage every year. So that means that the total emission, we have to constantly rebase the starting point, which is kind of a difficulty because numbers keep on changing, and with management we didn't want to do that. So the objective was to decrease the carbon intensity by 20%, and that was it. So then we may move the starting point, but it's always minus 20% of whatever that number may be. So number one, getting the information on from a third-party database. So that's the first, I don't want to say problem, but a challenge. The second challenge is that it's kind of, you are using emission 1 year behind because, as corporate deliver information, then it takes time for the third-party databases to collect and then provide those numbers back to us. So basically for 2021 update, we are using 2020 emissions. So it's good and bad at the same time. It's good because it gives you a one-shot reloading of all the emission, but then it's 1 year past. And, and now because of the COVID effect, we don't feel that the numerator is of good quality, let's say, but we'll see how the economy picks up in the future. The denominator has been quite positive because the equity market is good. Rates are really low, so the market value of the debt is pretty good, so the intensity mechanically is low. So we need to also learn about the volatility of this intensity KPI in terms of movement of the numerator and denominator. And this is by sector because the share of debt and equity by sector is different, so the volatility of that KPI is different. But this is what we are, learning and trying to do to steer, because the idea is to, for us, as we are picking and choosing now the right names to decrease the carbon intensity, we need to make the right decision. Once again, come back to the question earlier, that usually we don't sell. We don't sell, portfolios that we have, except in rare occasion, again, for accounting, solvency, AM issues. And just pure size. So as we buy usually long duration paper, that it be corporates, you know, we will not have that many chances to turn over the portfolio between now and 2050. Whatever we are buying now, we're stuck for a 2025 target, and we are probably stuck for a 2030 target also. So we have to be, again, you know, quite careful in what we are buying. So obviously, as time goes on, we'll try probably to stay away. Well, we will stay away from highly carbonated names, but not only, this is kind of an ex-post number. There is a lot of qualitative assessment also, because we need to mix, you know, with that also our views on where those companies are going. If we feel that there is high intensity and the companies are not going fast enough, then obviously we won't invest. We just cannot take that risk.
Okay, thank you. Maybe moving back to the banking sector, because I realize in the strategy that you just described that there's a lot of centralized decisions that are made at the onset on a relatively large portfolio. I can expect that on the, well, I would imagine that on the CIB side, it's you have to have effectively bankers change their approach in the way they originate transactions. So there's, I guess, a lot of people to convince within the organization. How did you manage to implement that within the CIB?
It's a major change project, indeed, because it's not only adding a new metric, it's adding a metric that has a very powerful impact on the way you look at a given activity, be it a sector or a business line. So there are a number of things we've done. One is associating from day one all the relevant bankers in the definition of our methodology, so that they get themselves trained and skilled on the climate science. Number two has been to work with them in an extremely bottom-up approach on their own budgets. So how they design their own forecasting of their activity, taking into account, you know, the I would say the importance or the size of any given client, but also taking into account the timing of our engagements with the clients, and more importantly, engaging in the relevant strategic dialogue with the various companies we're financing, to get a good understanding of who are our clients with the highest transition potential. Because I agree that our active management and monitoring of the topic is going to be crucial, but the reality is our transition is going to come from the transition, primarily from the transition of the clients we do finance, meaning that choosing the ones that have the highest potential for transition is absolutely key. So what we're trying to do is tooling up everyone to make that analysis and to simulate the impacts that decision making according to that analysis could have, and that involves all sorts of tools development, including a simulator.
And if I may, has there been any push from the various businesses on this strategy, and I guess debates on how do you assess the ability of a given company to effectively make its transition?
Of course, as you can imagine, there are sectors that are by definition heavier hit by than others in this trend. So it's been a journey. I think we've managed to onboard most of the sectors, including the ones that are absolutely not obvious. But I think what helped us is the actual client reactions to what we were putting together, and their own shift in strategy, because it became very obvious to everyone that we weren't being counter-cyclical with our approach. When the C-suite level started to spend half of their discussion with us on the topic of their own transition and how to make it happen, and I'm not being naive here. It is what we're observing, even with the highest emitting, or especially with the highest emitting industries. So yes, of course, many pushbacks, but we've started that process back in 2017, and I think we've done. We've gone a long way from where we started.
Thank you, Orit. Now, trying to get a more global perspective on what other players may do in other regions of the world. Nicolas, if you wish to comment on the progress made by other players of the industry.
Sure, Louise. So, first thing is the visible part of that effort to steer the balance sheet is really the target part. So as Orit mentioned, and Eric as well, I mean, the effort is much larger than setting the target, but really the visible part is the target and the commitment of the firm. That engages the firm, the C-suite, etc. All those commitments right now are being set within alliances. We've discussed the net zero asset owner alliances, the net zero banking alliances, etc. If you look at the group of banks, asset owners and asset managers of those alliances, Europe is still predominant as a region. It's more than 50% usually of the members. So Europe is still very engaged on that transition. So it's fairly important to have that in mind. And within Europe, so of course, we discussed some French institution right now, but UK is very strong in the region in terms of commitment of financial institutions, targets, mechanism, methods, etc. So that's for Europe. And then if you look elsewhere, basically, so you have a pretty balanced view between Asia Pacific, Americas, North, Latin America as well. Not so much financial institution in the Middle East and Africa, which we could expect. And surprisingly, more and more financial institutions in the US, which are very large financial institutions. And here we've got a very interesting context. Not only a market movement, which are basically those targets, as well as a regulatory movement in the US. So global picture is Europe still very much committed, and then we should have a very, we say, careful look about what's going on regarding United States financial institutions. So that's for the targets, and then we discuss pretty much what they're doing. So right now the approach for everyone is pretty much the same. Let's address the most material sectors in terms of CO2 emissions. I'm not talking about financial materiality here. The idea is really to address first in the portfolio the most obvious sectors. So basically power, automotive, oil and gas, etc. So everyone is pretty much working on those worldwide. That is pretty much consistent. Last thing, in terms of how financial institutions are tackling that topic, which is not, I would say, a consistent topic across region, is the question of offsets. So to what extent you could consider that offset is part of a greening strategy? That for you, I mean, Europe financial institution, the answer is pretty simple. It's not. I mean, we may have some differences, but basically the answer, it's not. The point of view may be different in North America and in Asia Pacific. So we will probably need to have a careful look on the discussions regarding the use of offset in the coming years, because some institutions will probably use offset to steer their balance sheet.
Thank you, Nicolas. Thank you all for your comments on this important question of steering balance sheet of financial institution. I don't know whether there are some questions from the floor.
You introduced green factors at Natixis, and if I understand you reduce the capital allocation to green projects and penalize in terms of capital allocation brown project. So if we end up with more green project than brown project, regulatory capital is going to be higher than the economic capital you'll have allocated to the various projects. So how do you deal with the situation?
As I said, Michel, that RWA adjustment is a analytical RWA. It's a purely internal a purely internal perception that we're building. So here, our capital, regulatory capital, obviously remains unchanged since the regulator doesn't ask for us to make such adjustments. So it's about providing an additional perception of performance at a deal by deal decision making. It's not actually moving our regulatory capital allocation.
Maybe another question for you, Eric, or for Oris. You've mentioned about the need for reliable data to do the various impact analysis, climate impact analysis. How would you judge the availability of data today and the quality of data that you find in the marketplace?
For liquid assets, so listed equities and corporate bonds, basically the space in which we invest for large scale investment. As far as I'm concerned, there are two topics in your question. One is the availability of data, and second is the reliability of the data. So availability, surprisingly enough, but it's encouraging. The coverage ratio is pretty good. We have. So this is in our climate report, so I can mention it's quite public, but we are in those two asset classes, over 90% coverage. So basically, because we are not into investing in companies that do not provide any kind of information. So it's also, that's the caveat that I have to add. And in terms of reliability, this is what we work on. We've been tracking carbon intensity only for the past 3 years. So there are more and more discussion with the data providers. So it's also in the climate report. We use TrueCost, as the major data provider. And, so we learn, we want to understand how those numbers, how they collected. There are some estimation that are being done in the past. So that's what we want to learn more of. Yeah.
Orit, do you have a view on that question? I believe you're in mute. We can't hear you.
No, I'm not. Can you hear me now? Yeah. I see accessibility and reliability and more importantly, quality of data as the key challenge for the years to come, especially in the private environment. I would agree, but the reality is the regulators. And the European regulation, especially, but not only, as we've just seen, the SEC and entering the arena, but I think we're going to see some sort of quantic jump in terms of data production. Doesn't mean it's going to be reliable from day one, but I think we're going to see a very massive production of data, thanks or because of that regulation push that is meant and has been designed to be ecosystemic. So each of the stakeholders of the economies being concerned with that requirement. But as of today, it is a very great challenge, and we've with our green weighting factor, it's the first step and the first dimension, which is in this case is the climate angle, where we're just decided to create the data ourselves on the basis of the documentation of our financing.
Thanks, Orit. I think we have another question from the room.
Yes, it was a question to Eric, because you mentioned the fact that when you're using carbon intensities, it's backward-looking. Are you considering also to use the firm's targets, or is there a reason why you don't want to use these targets? So you would have forward-looking measures. So why don't you consider their future projections as well?
So using as a target a forward-looking indicator.
What the firm forecast will be their carbon intensity in 2 to 5 years. Is it something you're considering as well?
So we have been in the climate report. We've been reporting, the warming potential or implied temperature rise from providers, But we don't use that as the target. We feel that as of today, even though it's past data, that at least we understand it better. Its emissions, scope 1, scope 2, divided by some numbers we can touch. Market value of debt plus capital versus some kind of methodology of, calculating a forward temperature type of indicator. We report it in our climate report, so we recalculate, we don't calculate any kind of indicators internally. So we rely on third-party data providers. We rely on, for the temperature, we rely on a third party. For carbon intensity, as I mentioned, we rely on true cost. I think, and I totally agree with Oritz, we're going to see a quantum leap in terms of data availability, hopefully in the convergence of temperature calculation, and things are going to get, it's going to be moving so fast that in the end we're going to let experts, and we're not going to be starting any kind of internal team, collecting data or recalculating some kind of forward-looking temperature. This is complex. It requires energy, time, resources, and we're going to let other people do that for us. We will see in the next so many years if we need to invest internally, but right now just using third party is what we feel is the better approach. And when I say that, this is only half the balance sheet. When I mention it's liquid assets, then you have the illiquid asset, which is totally another problem. So when we invest in infrastructure or private equity, loans through GPs, external GPs, we need those guys, to provide information on the individual deals that they are financing. It's a large part of the balance sheet. So, to be super precise on half of the balance sheet and not getting any information on the other half, I think we need to balance. I'd rather put now more energy working with GPs, forcing them to deliver information in term, with their regular reporting.
And that's what I believe the situations the CIB is in. You're probably more in the shoes, the equivalent shoes of a GP with well, in fact, a lot of intelligence to build on your own if you want to offer your clients with the information that they require. Thanks to you all for these insightful comments. No, please go. I think
I would like to ask about concentration risk. Aren't you worried about concentration risk and increased volatility of your portfolio once you exclude so many companies from your portfolio?
That's what I said. For the first target at minus 20%, 2020, I think that we can manage, reasonably well, keeping still our discipline around portfolio construction. I believe that the minus 50%, if that was going to be the case for 2030, that may lead us, to pick and choose in a much harder way there for the names in the various sector or abandon some of the sectors.
But
so
your competitors are doing the same.
Yeah.
So everybody will be tilting the whole portfolio in one direction.
But
so it will be actually fantastic opportunity to buy brown companies.
But that is also assuming nothing changed elsewhere. And my sense is that there is a strong push towards transition of a number of business models. I don't know whether, Orit, you have some comments to provide on this and some testimony on how the market's growing.
Yeah, I think first, I would not say neither Eric nor myself have talked about drastic divestment from part of the economy. At least the CIB is definitely not in that set of mind. We are strongly believers that the bulk of the reductions, the emission reductions, relies on the heavy emitting industries, meaning that we have not divested ourselves or decided to exit any of those industries, but rather support, enhance, incentivize transitions, and try and choose the ones or put our focus on the companies that have an ambitious transition pathway, under the assumption that those that are not might be cheap, but that might be for a reason. The topic of stranded assets have already materialized in some sectors, as you may know, and we're monitoring that very closely. So even if there are, and I think the current environment is posing for us a tremendous challenge to keep our eyes in the medium term and not necessarily go into the short term arbitrage that we're seeing in front of the consequences of the current crisis in Russia and Ukraine. I think those are arbitrages. So from a medium term management of our portfolio, we are monitoring concentration, and we are as well monitoring performance. So climate transition is not meant to be at the expense of the other financial metrics that we're monitoring.
Thank you very much. I think we have to stay on schedule. I would like to thank our panelists for their contribution and the audience for the questions. Thank you very much.